morning, good afternoon, or good evening, depending on where you're based in the world. My name is Daouii Abouchere, and I am a sustainable finance and ESG professional. What that means, I think you'll get a hint of it after this presentation, but in essence, my work is focused on embedding not only sustainable business strategies, but weaving sustainable investment strategies, working with investors and borrowers to develop bespoke sustainability strategies, and helping develop or create real economy outputs alongside financial returns. I'm also a member of the World Economic Forum, a fellow of the Royal Society of Arts, a faculty at competent boards, and recently listed on the Forbes 30 under 30 list of finance in Europe this year. So as you can imagine, this is a subject matter very near and dear to my heart, and one that I think is very important, not just because it's on every newspaper today, but really if we want to get to a just and sustainable transition, we do need to fundamentally shift how we look at markets. So I'll start off by talking about and setting the scene and talking about sustainable finance. Many of you have probably seen sustainable finance over the last 4 years really took off, and it's become an investment craze that's not only been taking off in the capital market scene, but also in politics, if you look at what's happening in the United States, as well as industry. And there isn't a single newspaper that you open today that doesn't have ESG headline or a sustainability headline. So what is it? So sustainable finance or responsible investing is the process of taking ESG considerations into your investment decision making. And ESG in itself is a framework, in my perspective, a scorecard that allows and helps capture non-financial material risk for investors. So what does that mean in layman terms? Historically, as many of you are aware, finance rarely took into account things that were not on financials or balance sheets. However, the world has shifted and changed, and now these non-financial factors do impact the performance of companies. So ESG as an acronym encompasses 3 things. They're not all inclusive. They can be standalone, and this list is not exhaustive. So on the environmental front, the factors we're looking at here are based on the company's interaction with the physical environment around them. So looking things around climate change, biodiversity, natural capital, carbon emissions, pollution and resources. On the social, here we're looking at a company's impact on its direct society. So how are they managing human capital? Worker health and safety, labor standards, and also product liability, their own products they're producing. How secure are they and safe are they for human consumption? And also privacy and data security. On the G, here what we're looking at is how a company is fundamentally governed. So looking at things around diversity and inclusion. How transparent are they? Corporate ethics, board independence, and risk management. I know we're not here to argue semantics, but if I was to argue, it should be GSE or GES, because when you have good governance, in essence, you should have good social and environmental performance. So you might be wondering why this is important. As I just mentioned, historically, corporations worried about one thing, and that was bottom line profits. However, the world's changed, and we're in a state of increased uncertainty, both from market volatility and external shocks. So we saw that happen with the COVID-19 pandemic, which not only disrupted our lives and our livelihoods, but halted supply chains globally, halted travel, and businesses, which unfortunately went under because they were not prepared. And it really tested supply chain resiliency. Now we're feeling the effects of the recession, and businesses, alongside the war, I should say, which has exacerbated this recessionary climate we're feeling. Businesses are not only struggling with supply chain, but the cost of living and other impacts on our economies and on businesses. And lastly, a factor that the markets are just starting to price in is climate change. And we haven't actualized the effects of climate change and the impact it's going to have. There's projections, but we don't know what it's going to fundamentally look like and what changes our lives. We're seeing some issues around, or some details around what it would look like with flooding around the world in supply chain hubs. Pakistan recently is one, and how it might impact. But climate change has the possibility of disrupting not only the way we live, but huge human factors such as food security, water scarcity, and others. So just a couple of factors and why they matter. So the E, environmental uncertainty, as I mentioned, the climate crisis. This graph from the Swiss Re Institute of Economics of Climate Change details what would happen if we do the temperature scenarios. In the severe case, though, if we do nothing and global temperatures rise by 3.2 degrees, on average around the world, we'll see a net wipeout of 18.1% of GDP globally. If we maintain temperatures well below the 2-degree increase, which is our Paris target, we'll only see a wipeout of about 4.2% of the global economy. But what I find fascinating about this is when you look at Middle East and Africa and Asia in the severe case, so if temperatures rise by 3.2 degrees, it's a wipeout of 27.6 and 26.5% respectively of their total GDPs. When we contrast that and compare it to Europe and North America with 9.5% and 10.5% of a GDP wipeout, it tells a very interesting story. Those at the forefront of the climate crisis are not the ones in OECD countries, and they're the ones in the most vulnerable and oftentimes dire both socioeconomic and democratic government situations. And they're oftentimes not the ones who are emitting these CO2 emissions or polluting the world at the levels. So it's an interesting observation. Moreover, the climate crisis, as I mentioned, will wipe out about 18% of world GDP by 2050 if global temperatures rise by 3.2 degrees. That impacts 48 countries, representing 90% of the world's economy. 132 million people will be pushed into poverty over the next 10 years. And $18 billion a year in natural disaster costs will be required for low and middle income countries through damage to power generation and transport infrastructure. And an S, uncertainty, was the pandemic. We saw huge market turbulence and economic uncertainty. 9.7% decline in UK GDP in 2020, and the magnitude, which is the magnitude of the recession caused by the pandemic, according to the Bank of England. And if you look at the chart on the left, the graph, apologies, you can see majority of the world economies are in recession exacerbated by the pandemic. And S, uncertainty, is the Great Resignation. So we saw impacts and turbulence. For those of you who are not familiar with the Great Recession, it's a term coined by a professor in Texas, and it basically means that it's a considerable shift in employees' attitudes towards work has exacerbated by the pandemic crisis. 40 million people have quit their jobs globally in 2021, which is an all-time high, and the share of workers, and this is the share of workers who are voluntarily quitting their jobs, reaching record numbers in September. Another ESG factor is diversity and inclusion. So the Black Lives Matter movement since 2020 with the death of George Floyd really heightened and showed how important diversity and inclusion is. McKinsey says the relationship between diversity on executive teams and the likelihood of financial outperformance has strengthened over time. If we recall, when the Black Lives Matter movement in 2020 reached its height, and in social media, many corporations were putting out statements and making financial donations to diversity and inclusion. However, it was interesting to observe with consumer activism how it also heightened during that time. Many large apparel brands, for example, a large footwear company, decided to put out a statement. Activists quickly went on their website and took a screen grab of their board and their senior executives and called them to task for it and said, put your money where your mouth is. You're speaking about diversity and inclusion, yet there's not a single person of color or a racial minority or a woman on they had, I believe, one woman on your board and executive, but yet you want to have a marketing campaign on D&I. That led to a blackout campaign, a boycott campaign, apologies, and activists were calling for boycotts of certain brands for not walking the talk. And on the graph on the left, it's interesting to see, and there's a direct correlation in my perspective between companies that are consumer facing and how close they are to consumer activism versus companies that might not be. So if we look at the bottom of the chart, the companies in the energy sector, about only 11% of them had made a media response. The next 89% had no response, nor were they called to task for it. When we contrast that to consumer staples, about 43% have made a media response. An additional 30-odd% made a financial response, and about 8 to 10% of them had to make an organizational response and reshuffle due to activism. Geopolitical uncertainty. So we're also seeing the Russian invasion of Ukraine. The slides were made back in March, so it's a bit outdated. However, there was about $1.4 billion of emergency financing made for Ukraine. We've seen more than 1 million refugees across the world, and we've seen spillovers in trade disruptions, food and commodity increases. I think this winter, a lot of us are feeling the pinch of rising and soaring gas prices. So all this to say, sustainable finance is on the rise. Mega trends are shaping the world, and markets, investors are taking notes. So from the climate crisis, we need to find viable market solutions for the climate crisis. In terms of regulation, especially here in the UK and in the European Union, it's becoming mandatory by law for large corporations to disclose environmental and sustainability reporting and make that transparent. Risk management, many CEOs and board members see ESG or sustainability as a good risk management performance, because oftentimes these factors are tied to performance and supply chain and efficiencies. Walter has touched on this. Companies that are sustainably focused oftentimes tend to perform better in the markets. And that's due to the fact that they're ring fencing and capturing a lot of these issues that have the opportunity to derail their profits and their market performance. And lastly, shareholder activism. Now more than ever, consumers are purchasing based off of principle rather than price. And consumers are now wanting to purchase or be associated with brands that are aligned with their own personal values, and they're calling companies to stake when they don't match. So quickly, the value of sustainable investing in 2020 is one third of all total investments, $35.3 trillion of sustainability assets under management worldwide, and that's set to grow. And the share of investors who think ESG factors help mitigate risk management have grown exponentially, with 80 to 85% of investors in Canada and Europe saying it makes good risk management sense. ESG can be applied in many asset classes and products, from commodities all the way to real estate equities. It's more developed or sophisticated in certain asset classes, but I don't think there's an asset class today that doesn't have an ESG integration or thinking about sustainability. And the sustainability, the impact changes. So passive is what I would call an avoiding. So that's exclusion lists and norm-based screening. So excluding companies or industries that breach international norms or are involved in activities such as weapons trade, tobacco, to give you some examples. Companies or investors that promote sustainability oftentimes integrate ESG. So what that means is they take into account ESG factors into their investment decision making. Best in class, so investments in companies with higher ESG scores, or sustainability themed, so investments to address the specific sustainability issues such as climate change and water supply. And then you'll see investors that are a bit more active in what I would like to call the change investors. And those are the ones that are truly impact investing. So investing in solutions or companies that are aimed at that have social and environmental benefits in the real economy. And investors, especially in the private equity and the private part, where are engaging in voting. So active investors taking an active role in the company. So voting at shareholder meetings, engaging critically with not only the board of the companies, but also the C-suite, and transforming how companies look at sustainability and what their sustainability footprint is. So ESG in practice, what it really does is identify and measure sustainability characteristics. As I mentioned when I started, it's a blueprint, and it allows companies to capture risk, so leveraging data to apply ESG factors into a bottom-up risk-reward assessment. And it's important to mention risk-reward because sustainability and ESG is not always objective. There's a lot of subjectivity depending on the different factors. And also, the world doesn't operate in black and white. So it's about understanding the risks, the rewards, and the opportunities to help transition companies or move the dial to do a bit better. Second is sustainability research. So using excellent investment insights from sustainability research and experts to understand what's happening. The world is ever shifting and changing, and as sustainability specialists, we need to stay abreast on what's happening in different industries, different sectors, dependent also underpinned by geography. And what we'd like to do is engage for impact. And impact is a very subjective word, but having upstream, direct, and indirect impact. If you're wondering, these are in terms of the supply chain. So direct impact is directly with the borrower. Upstream is with their suppliers and their business partners. And indirect impact is with consumers and what goes out in the market, and ensuring that the whole value chain or supply chain of that borrower you're engaging with is sustainable or doing no harm in effect. Excuse me. And lastly, managing and monitoring risk. So we want to engage toward a transition rather than risk manage our way to a transition. Like I mentioned, the world doesn't operate in black and whites, and many sectors, for example, oil and gas, are required in the next 10 to 20 years in order for humans to live a dignified life. However, how do we transition off of or wean off of the reliance on oil and gas? What research and development needs to be done? What does a carbon neutral world look like, or a net zero world? So it's about engaging with these companies and also with peers in the market to really shape what the transition looks like. So sustainability or responsible investing is an opportunity for, it's a market opportunity to meet our global goals. So not only will it impact, have real economy outcomes, so focusing on both financial investments and real economy outcomes, it also has the ability to incorporate SMEs. SMEs have been left out of the conversation for far too long, and the focus has been on large companies, rightfully so. However, on aggregate, SMEs have a larger sustainability footprint, and in my perspective, are more nimble and able to adapt to sustainability challenges rather than the large corporates. Also, with the incorporation of SMEs, you're improving their credit portfolio performance, mitigating reputational, operational, and financial risks. You're truly engaging through capital, so financial incentives for suppliers that meet certain environmental or social standards. I love the phrase follow the money, or using the carrot and the stick analogy. The money is the stick, and I think you can influence not only consumer behavior, but corporate behavior through costs of capital and financial metrics. And lastly, what we're trying to do is build supply chain resilience with sustainable finance, ensuring that our supply chains are ring-fenced against vulnerabilities and shocks, but fundamentally not leaving the world worse off. So doing good, doing no harm, but also trying to do good. So the future of sustainable finance, I think this is a trend, as some American regulators or governors would like to call it. However, I think it's here to stay. And we've seen that through disclosure and reporting. So it's a step forward. The EU has released a slew of taxonomies and regulation, disclosure regulations and requirements for not only corporations, but for investors as well. We're going to see ESG data enhancement. Data has always been a challenge, especially for privately held companies, to see what they're doing and assess, and we're going to see data only improve over time. The S, social in ESG, is going to come to the forefront. If we're going to have a just transition, then we need a human-centric approach to climate change, and we see that with discussions in COP27 this year as well. We're going to find solutions to not only just carbon, however, biodiversity and natural capital, so assessing how we engage with the natural capital around us and community. Hopefully better market-led solutions to climate change will come to the forefront. And one that's a discussion that practitioners are always having is the argument between divestment versus engagement. Do you divest and not engage with companies and sectors that you think are objectionable, for example, coal? Or do you engage with them and work with borrowers and market peers to find solutions and help those sectors become sustainable? A prime example is palm oil sector. Investors and multinational stakeholders and groups have done tremendous amount of work to ensure that palm oil is sustainable and traceable. And national economies, namely in Southeast Asia, are better off for it. So the debate between divestment versus engagement will continue to be had. And I think it's a useful debate as it challenges our thoughts and our opinions around some of these challenges.